if you got some money you're sitting on right now, I would buy your mutual fund like tomorrow.
According to Dave Ramsey, if you have money, you need to invest today. Do you remember the aftermath of the 2008 financial crisis? That period, marked by uncertainty, eventually led to one of the most significant bull markets in history. Fast forward to today, and we're standing at a similar point in time, with the S&P 500 hitting record highs and indicating a strong year ahead. A recent article from Reuters perfectly captured this feeling by showing how the S&P 500 has risen to levels that have never been seen before, driven by hopes for lower interest rates and strong growth. Meanwhile, Goldman Sachs research is forecasting a 6% return for the S&P 500 in 2024, suggesting that, despite high equity valuations, the market still holds promising opportunities for investors. These insights set a compelling stage for our discussion. Today, we're going to talk in detail about why 2024 is not just another year, but a huge chance for investors. These insights come from Dave Ramsey's advice and are backed up by solid research. We will talk about what this means for your portfolio, why you might need to act right away, and how to make smart investment choices this year. Ready? Let's get started. Alright, let's break this down so it's super clear, especially if you're new to all this stock market stuff. The S&P 500 hitting record highs is big news, and here's why it matters to you, even if you're not a Wall Street expert. So what is the S&P 500? Imagine it as a giant scoreboard that tracks how 500 big companies in the US are doing. When the score goes up, it means, on average, these companies are doing well. Recently, this scoreboard hit its highest number ever at 4,839.81. This isn't just a random high score, it's like a signal flare saying, hey, things are looking up here. You might be thinking, okay, but why does this high score matter? History gives us some major clues. After really tough times, like the 2008 financial crisis when the economy took a major hit, the S&P 500 started climbing and kept going up a lot. It went up over 400% by 2020. That's like turning $1 into $5 over those 5 years. When we see the S&P 500 reaching new highs, it suggests we might be at the start of another period where things keep getting better for a while. Now let's sprinkle in some facts. Research shows that in the years when the S&P 500 sets new records, the return, or the money you make on your investment, is usually around 10 to 15%. That's pretty good, considering the average savings account gives you way less than 1%. Over long periods, the S&P 500 has provided significant returns to investors. For example, from its inception in 1928 through the end of 2023, the S&P 500 has returned an average annualized return of about 10.26% since adopting 500 stocks into the index in 1957. This includes periods of both record highs and lows, reflecting the market's cyclical nature. Investing in the S&P 500 during years of record highs can be seen as an optimistic bet on the continued growth of the U.S. economy and its largest companies. While past performance is not indicative of future results, the historical average annual returns suggest that the stock market over time has trended upwards, rewarding long-term investors. But what's pushing the score up, you might ask? It's not just one or two things, it's a bunch of factors. Lately, technology and artificial intelligence have been big players. It's not about making quick money on a trend. Actually, these tech advances are altering how we live and work, and they are supporting the market rise. Economically, things are looking a bit brighter too. Inflation, which is when prices for stuff we buy go up, is starting to chill out. The Federal Reserve, which is like the economy's thermostat, is hinting that they might not hike up interest rates much more. This is good news for the market because high interest rates can slow things down. What does this mean for people who are thinking about investing? This high score on the S&P 500 is like a green light, saying it's a pretty good time to start. The market's momentum and solid ground of tech growth are like a double thumbs up for investing now. In simple terms, if you've been waiting for a sign to get started with investing, this is it. The market's showing signs of strength, and there are opportunities out there for the taking. Remember, investing is about the long game, and right now, the game looks promising. Let's look at some historical moments and what they teach us about seizing opportunities in times of uncertainty. Firstly, consider the dot-com bubble burst at the start of the millennium. It was a tough time for investors, with the S&P 500 plummeting by almost 50% from its peak in 2000 to its trough in 2002. Yet those who stayed invested or entered the market at low points saw substantial gains in the following years. By mid-2007, the S&P 500 had recovered all of its losses and reached new highs. This cycle of decline and recovery emphasizes the importance of patience and long-term thinking in investing. Fast forward to the 2008 financial crisis, another pivotal moment for investors. The S&P 500 fell by over 56% from its high in October 2007 to its low in March 2009. However, the subsequent recovery was remarkable. By 2013, the index had doubled from its 2009 lows, and by 2020, despite the COVID-19 pandemic's impact, it had more than quadrupled. Investors who recognize the cyclical nature of the market and invested during those downturns often reap significant rewards. These historical instances highlight not just the resilience of the market, but also the opportunities that downturns can present. They teach us that while the market's short-term movements can be volatile and unpredictable, its long-term trajectory has been upward. For investors, this shows how important it is to stay informed, be patient, and keep a long-term view, especially when the market is volatile. Dave Ramsey is pretty clear on this. If you've got some extra cash, it's smart to start investing it right away. You might be wondering, should I wait for something big, like the presidential election, to happen first? Well, history shows us that waiting around for the perfect moment usually means you'll miss out on some good opportunities to grow your money. And this is what Dave Ramsey has to say about this specific concern.
Waiting until after the presidential election in November to do your investing, that's probably a dumb idea right now.
And if you're thinking about pulling all your money out because you saw some headlines, don't do that either.
Yeah.
We found that if you just ride this roller coaster over time, you're going to hit a new record high and a new record high. And then
it's going to go down. And then it's going to come up. And then it's going to go down. And then it's going to come up. This is how life works.
Here's the thing about the stock market. It tends to go up over time, even though it can jump around a lot in the short term. For example, if we look at how the stock market has done in election years, it's interesting to see that most of the time, the market ends up higher at the end of the year. This has been true no matter which political party wins. So, waiting for an election to decide before you invest might not be the best strategy. Now let's talk numbers for a second. There's this idea of timing the market versus timing the market. Basically, some of the best days in the stock market come out of nowhere. If you're not already invested, you'll miss them. A study by JP Morgan showed that if you missed the 10 best days of the stock market over the past 20 years, your returns would be way lower than if you just stayed invested the whole time. And here's another cool thing about starting early: compounding interest. This is where you earn money on the money you've already made from your investments. The sooner you start, the more you can make from compounding, which is another reason why investing now makes a lot of sense. So if you're thinking about waiting for the next big news event, like an election, remember that the market keeps moving, and the longer you wait, the more you might miss out on. Investing now gets you in the game and allows your money to start growing. Sure, the market will have its ups and downs, but history tells us that over time, it's more likely to go up than down. When we talk about investment opportunities, it's impossible not to mention real estate. Just like the stock market, the real estate sector is showing signs of significant growth potential. The current market dynamics, characterized by a housing shortage and fluctuating interest rates, set the stage for potentially lucrative real estate investments.
Is real estate going to go down? No, it's not. We have a tremendous shortage of housing.
And this is what Dave Ramsey says about real estate investment. A critical factor driving the real estate market is the acute housing shortage. The National Association of Realtors reports a staggering shortfall of over 5.5 million housing units in the U.S., a deficit that has been building over the past decade due to underproduction. This shortage is pushing demand to unprecedented levels, with median home prices rising by 16% year over year, according to Zillow's latest data. For investors, this trend signals the potential for property values to appreciate, making real estate an attractive investment channel. The remote work revolution, accelerated by the COVID-19 pandemic, has reshaped residential real estate preferences. A survey by Upwork estimates that 36.2 million Americans will be working remotely by 2025, driving in demand in suburban and rural areas where people are seeking more space and a better quality of life away from crowded city centers. This shift opens new avenues for real estate investors outside traditional urban markets. Technological advancements, or prop tech, are revolutionizing how real estate transactions are conducted. Online platforms are simplifying the buying, selling, and property management processes, making real estate investment more accessible. According to a report by Deloitte, investment in prop tech startups reached $23.8 billion in 2021, indicating the sector's rapid growth and the potential for technology to enhance real estate investment returns. Sustainability is becoming an important thing for both buyers and renters. Properties that offer energy efficiency and sustainable living features are not only in high demand, but also command higher prices. The vacation rental market is experiencing a resurgence. This trend presents a lucrative opportunity for investors in tourist hotspots to capitalize on the growing demand for short-term accommodations. In the commercial sector, the rise of e-commerce has led to a boom in industrial real estate. CBRE reports a record low vacancy rate of 4.4% for U.S. industrial and logistics space in Q4 2021, with demand driven by the need for warehouses and distribution centers. This shift suggests that industrial real estate is a promising area for investment, offering high returns as online shopping continues to grow. Basically, the current trends in the real estate market, the lack of homes, changing interest rates, and changes in people's work and lifestyle choices, make it a great place for investors to put their money. So, what's Dave Ramsey's advice? Let us get our answers from what he is doing for himself.
So I got to tell you, what is Dave Ramsey doing right now? Buying. Period. Investing. Period.
Dave Ramsey's investment philosophy is straightforward. Start investing immediately, consistently contribute to your investments over time, and ensure your portfolio is diversified across various assets like stocks and real estate. This method stresses how important it is to start investing as soon as possible and keep adding to your portfolio. Diversification acts as a safety net, protecting your financial health by spreading risk across different investment types. By staying informed and making educated decisions, possibly with the guidance of a financial advisor, you can explore the markets more effectively. Ramsey's strategy is a practical blueprint for building wealth steadily, regardless of market fluctuations. Now I leave you with 2 questions to ponder. Are you ready to take the first step and start investing today, setting the foundation for your financial future? And how will you diversify your investments to ensure you're prepared for whatever the market brings? Remember, the path to financial growth is made easy by informed decisions and strategic actions. Let's make 2024 the year we adopt Ramsey's strategy and invest in our futures.